Greetings everyone, Fernando here. I put together this short video on how real estate investors or potential real estate investors can evaluate the performance of a rental property. So if you're interested in purchasing a rental property or you have a rental property that you're thinking about selling, how can you deem the effective performance of this building, profitability, all the key ratios that the banks are going to be looking at, and how can you determine how much money you're actually going to make on this building. So I'm going to use what's called a Property Proforma, which is a fancy word for projected performance, and I'm going to go through the key ratios of that Property Proforma. So without further ado, I'm going to jump right into the video. I'm going to share my screen and go into what a Property Proforma looks like. So I am going to share this with you right here. So this is what a Property Proforma looks like. It's actually broken up into four main components. The first is the basic information about the building, such as the address, the number of units, and all the critical information so that you can identify that this is the building that you are looking at and analyzing. The next section is the income, which is basically the total rents coming in, discounted with vacancy rates and any economic loss that we'll get into momentarily. The next is all the operating expenses associated with running this building. So anything related to taxes, utilities, insurances, anything that is required to be expensed out to run this building smoothly. And finally, the most important part of the pro forma is the performance metrics. And I'm actually going to go through the performance metrics twice because it's so important. It is essentially the key ratios for you to determine how good of an investment this is and what kind of returns you're going to get on this building. So really quick, I'll fly through this section here. This is, again, the basic information of the property. I'm going to go through an actual example over on a spreadsheet later on. So this is, again, the property address and some important components there. Again, I will go through this section again. This is the total income that the property is going to generate. Again, we will go through this section in our spreadsheet momentarily. The third section of the pro forma is the operating expenses, and that you see the total listing of operating expenses. Many times when you're presented from a seller with the operating expenses, they will not list half the expenses that I have listed here, but I have run a property management company for over 12 years, and I have seen the performance of every kind of investment building that you can imagine, from older multifamily buildings to brand new construction. So I know that these are the actual components of real expenses that real people will face as they buy buildings. And here is the most important part. Again, I am going to go through this twice. I'm going to go through the performance metrics here, and then as I jump into the spreadsheet. So the performance metrics are, these are the main components of how you want to analyze a building. The first is your net operating income. Your net operating income is the adjusted gross income. So basically the total income of the property adjusted to account for any vacancies and any economic loss, which we'll get into momentarily, less your total operating expenses. That's going to give you your net operating income. Your debt service is your mortgage payments. Now, if you have financed this building, you're going to have a monthly mortgage payment to a bank. That mortgage payment annualized over a year is what you see there. That's the total debt service for the year. The next ratio, which is called the DSCR, or debt service coverage ratio, this is probably one of the most important ratios, especially for the bank. The bank is going to be heavily focusing on this ratio. And this ratio is your net operating income divided by your debt service. And quite honestly, what this debt service is communicating to you is how much money is left to service the debt. How much money is left to service your mortgage payment after all operations have been paid. So in this case, there is, for every dollar that comes in, there's $1.83 to service your debt. So in other words, there's 83% more. There's 83 cents more, rather. For every dollar that comes in, there's 83 cents more left over after servicing the debt. So there's 83% more. You're in a secure position. The bank is typically looking at any debt service coverage ratio of 1.25 and greater. So if you have a 1.25 and greater, it says that, hey, I have 25% more money left over after servicing the debt. Oh, before servicing the debt. So 25% more before servicing the debt. So that is, so if it's a 1.0, I'll give you a simple example. If it's a 1.0, it states that for every dollar that comes in, I've only got $1 left to pay the mortgage. So I'll say that again so that it's a little clear, because I was a little unclear on that. So for every dollar that comes in, I have $1 to service the debt if it's a 1.0. If it's a 1.25, for every dollar that comes in, I'm servicing my debt, but I have 25% more, which is actually my profit margin. In this case, in the 1.83, that says that, hey, for every dollar that comes in, I've got 83% left over, 83% more money left over, even after servicing the debt. So I'm in a pretty healthy position here. The cap rate is your capitalization rate, which is your return on your investment. So in other words, the total return on even getting involved in this investment. So in this case, it's your net operating income over your purchase price. The cap rate is a term that you will hear a lot of investors throw around. You'll hear statements like, hey, in this region, properties are selling at an 8.25 cap rate. So if you hear that and you are trying to deem an effective purchase price of the building, you would do the math and say you'd go 8.25 equals your net operating income, divide, and hopefully you do have that effective number from the seller, and then you want to make sure you got all the components that I have stated here. You divide that by your proposed purchase price, and you can do reverse math and you can obtain a effective purchase price on the building. Your cash on cash return, the next ratio there, is the amount of return on your down payment. So when you purchase this building, or when you're proposing to purchase this building, you're going to have a down payment to the bank that the bank is going to require. What kind of return are you getting on that down payment is what this measures. So in this case, this is a pretty good return on cash. You can see I'm getting 23% on my return on cash. And then finally, the last statement there is your cash flow after debt, and that is the effective cash flow after the debt has been paid. So after your mortgage payment has been paid, that is your free and clear cash flow. In other words, your profit. That is the money that actually goes into your pocket. So I'm going to jump into an actual example, and I'm going to go through. So this is the actual pro forma that I'm sharing with you, that I'm giving you, everyone, access to, that you can actually run your own numbers. So this is broken up again into 4 sections, similar to what we went through. The top section here is your basic information, so the property address, the number of units, and let's go through that. So this is the property address. I've just stated a fictitious address here. It's a free-form entry. This is the number of rental units. So in this case, it's a 3-unit apartment building. This is the proposed purchase price of the building. And this is your finance cost, which is any cost associated with that the bank may require you to, such as closing costs or any short-term borrowing of money, or any monies that you need to come to the table to get a loan. The capital expense budget is a really important component. In this case, I've defaulted to 0, but this is something you really, really want to be pay attention to. A lot of people do not pay attention to this. This is as you walk through the property, you want to analyze the property and look for any what is called deferred maintenance. So if there are components of the building that have been neglected, such as the roof, such as the heating systems or the air conditioning systems, or the lighting structures, or the common areas, you want to plug that number in, because once you buy the building, you will be stuck with the building. You will be stuck with all these expenses. So you want to identify these and either try to get the bank to finance these, or hopefully get the seller to incorporate or give you a credit for some of these, or even have them take care of it. So in this case, for the purposes of illustration, we've just kept that at 0. This is your down payment that the bank is going to require you to put down on this building. So your total purchase price is $197,000. Our income here is this is the second section of the pro forma. Your base rent is your total rent, so the total number of rents that are projected to come in. So it's essentially a review of the leases of this building. So in this case, you would be reviewing 3 leases, make sure that that's the rents that are projected to come in. And any other income, such as laundry income, if the building has that. If there are storage spaces and garages, you could add that income. And so you have a gross potential income of 36,360. The 2 next items are very important, and many people do not place an emphasis on this. This is called your vacancy loss, so which is the total vacancies. At any given time, you could have a vacancy in the building, and that is where you will not be collecting rent because the apartment is empty. You definitely want to plug that number in. In this case, it's a 2% vacancy, which is a very low vacancy rate. I run a property management company, as I have stated. I've run this company for 12 years, and in my local region, I track my effective vacancy rate, and in my region, my vacancy rate is about 4%. So you want to contact your local property manager and plug that number in. Economic loss is something very, very important. Most people do not plug this in. Again, for illustration purposes, I have kept this empty, but this is essentially your worst case scenario. This is a tenant who's occupying space but has chosen not to pay rent for one reason or another. So eventually they're going to be evicted, hopefully, or some kind of turnaround will happen. But here they are occupying the space and they're not paying rent. Unfortunately, in this case, they're hitting both sides of your pro forma. They're affecting your income. They're causing an expense to you, but they're also affecting the expense side of it because they're consuming utilities and space in the building. So for the purposes of illustration, again, we're keeping that as empty. Your adjusted gross income then is whittled down to 35,000. As you can see, it's about $1,000 less. You really, really want to focus on making sure you understand what your vacancies and what your economic loss are, because these are real numbers that you are going to face. I can guarantee you are going to have vacancies and you are going to have situations where you have economic loss in a building. So you want to factor those in. Your operational expenses is the third part of your pro forma, and just running from the top, this is your management fees. So should you choose to hire a property management company to take care of your building, you would be paying roughly, in this case, 6%. Management companies range anywhere between, on average, 6 to 10% of your gross collected rent. So in this case, it's 6%. So you want to make sure you have an idea on that. These are all your utility expenses. These should be confirmed. If you're evaluating a building, these should be confirmed. I recommend that you call your local utility company or ask for receipts so that you can actually confirm these numbers. Insurance numbers, again, I would definitely get a quote on insurance. Look at the current owner, what the current owner is paying, but also I would get a projection as to what you potentially would be paying once you took ownership on this. Real estate taxes, again, you can take that from the seller of the building, but I would verify with your local tax office, your real estate tax office or your municipality, and ask them how much, in fact, the taxes are. One additional thing is I would ask your local tax office if there's any projections or any anticipated tax hikes, because if you take ownership, then you'll be responsible for that delta in tax hikes. Professional legal fees is anything associated with the evictions or any entity creations, basically anything that you would need an attorney for. Grounds maintenance is your, if you're living in snowy weather, it's your snow removal and your lawn care and mowing expenses and general exterior cleanup of the building. Maintenance and repair, this is very important. This, again, many of these expenses that I've listed here, sellers typically do not list. I do list these because, like I said, I've run a property management company for 12 years. These are real expenses that you will experience. If you get an ineffective number presented by your seller, because many times they will downplay this number, I run, depending on the type of building, If it's a newer building, I'll run anywhere between a 5 to 10% of your gross potential income. If it's an older building, such as an older multifamily, many of which I manage, you're looking at anywhere between 15 to 20% of gross potential income. The reason for that is many of these buildings have multiple different types of plumbing facilities, and so it's very laborious to do work on these buildings. So the labor is definitely much higher, and the maintenance and repair costs are much higher. Your average unit turn cost is the cost to turn the unit, the cost to, once a unit becomes vacant, all the work associated with rehabbing the unit and getting it back on the market and rent ready. And finally, the last two is your advertising fees and your leasing fees. You will want to check with your management company what your releasing fees are, because typically a management company will charge you a management fee, but also if they find you a tenant, they're going to charge you a leasing fee to release that unit. And finally, we're back to the performance metrics that we went over again. I'm just going to run through these again. Net operating income is your adjusted gross income less your total operating expenses. Your debt service is your total mortgage payments that are annualized over the period of time. So it's basically your monthly mortgage payment multiplied by 12. Your debt service coverage ratio is the amount of cash left over to service the debt after all expenses have been paid. So after all been paid, how much money is left over to service the debt? So in this case, there is, after all the expenses are paid, there's 48% more money left over to take care of the debt. So I'm in a pretty good position here. After I pay my debt, I would have basically 48% of money left over. So again, let me go through this ratio. A 1.0 says to me that for every dollar that comes in, there's a dollar going out to service the debt. So the bank would get nervous in a situation like this because they're saying for every dollar that comes in, all my expenses are paid, and there's only enough money to pay the mortgage. In this case, it says that for every dollar that comes in, a dollar goes out to pay the mortgage. There's 48 cents left for the owner, so that the owner has a cushion, and the owner also has effective cash flow to feel comfortable with this building. Cap rate is the total return on getting involved in this building. This is the capitalization rate, which is your return on your overall return on investment. It's your net operating income divided by your purchase price. And your cash on cash return is the amount of return based on your down payment. So in this case, we had a down payment of, our down payment was 39,000. Basically, how much cash am I getting as a return on that down payment? In this case, it would be the 6,000 divided by the down payment, and that'll give me my rate of return on my cash. And then finally, that is your cash flow. That is essentially your free and clear cash flow that goes into your pocket. So with that, guys, I appreciate the time that you've taken to listen to this video, and I appreciate you using this, and good luck in your investments in the future, and thank you so much. Take care.